How do you scale up your small business? My name is Jeff Schuster with Mechanics and Mindset Business Coaching. In this video, I will show you a step-by-step process for creating a scaling plan that will ease your growth anxiety. So let's get started. The first step is imagining your company at a future point that it's much larger than it is today. I'll use an example of a $500,000 per year business that wants to be a $10 million per year business 10 years from now. Next, estimate labor and material costs per product. Don't get carried away. Try to group product types into no more than 10 groups. We will target a 50% gross margin. This means that 50% will be direct cost labor and materials, and the rest will be used to pay for overhead and profit. Next, estimate the quantity of each product that you plan to sell to reach your target revenue. Now that you have the quantity of products to be sold, you can assemble the people that you need to deliver your products. First, determine the cost of the workforce required based on the number of products. Knowing the hourly wage rate, you can calculate how many workers that you need. I'm using an 80% efficiency rate in this formula. Your workers will spend 20% of their time not directly doing work. This could be travel time, meetings, or other time that you can't charge to jobs. Since we have so many workers in our target year, we need to provide managers for these workers. A good rule of thumb is to estimate 1 manager per 8 workers. Notice that we have 9 managers, so it's a good idea to include a manager for the managers. This is often called a director. Now you have a good idea of what your operations department will look like in your $10 million company. Sales and marketing are estimated very differently than operations. Let's first envision our sales and marketing funnel. For our fictitious company, we've estimated that we need to have sold 1,650 products in the $10 million year. If we have a close rate of 40%, we need 4,125 appointments. And if we have an appointment rate of 50%, we need 8,250 leads per year. We can now estimate the cost and staffing for sales and marketing. It's important to note that marketing and sales can be done differently in different industries. For our example company, we will use digital marketing to gain leads and salespeople to conduct appointments and close sales. I've estimated it will cost $20 per lead, $200 per appointment, and $300 per closed sale. I now translate these costs into a marketing and sales staffing plan. Since we have an estimated 16 salespeople, I am including 2 sales managers. It's important to understand that your estimated salaries for salespeople include sales commissions. How you break up sales commission and salary will vary by industry. We now have a clearer picture of our organization in this $10 million year. Now that we have a sense of how many people will be present in the $10 million company, we can guess at the administration team that we need to support our employees. In our case, I have estimated a well-paid CEO, an office manager, a bookkeeper, an executive assistant, and a human resources manager. We can now see what our entire organization will look like at $10 million. The next step is to guess at other expenses necessary to support this $10 million company. I have created a simple budget that seems reasonable for our example company. At some point, it's essential to do the math to calculate how much you will spend on materials for the $10 million business. We can now prepare a profit and loss statement for our $10 million company. A profit and loss statement shows the total revenue. We then subtract our direct costs to see the gross margin amount. From our gross margin, we subtract other expenses to show the net profit of the company. In this case, our $10 million company is showing a profit of $830,400. As a rule, most companies should have a 50% gross margin. This 50% gross margin is comprised of 20% sales and marketing costs and 20% administration and expenses, and then 10% profit. Our example company is not doing as well as I'd like to see. Our profit is 8.3% of revenue. This is primarily because our gross margin is only 42.1% of revenue. In our case, this is lower than 50% because of the 80% inefficiencies that we included in our workforce. Let's not worry about that now. 8% net profit isn't that bad. We need to return to our current reality and then model our current financial situation. This is what the current profit and loss statement looks like. The same cost categories exist. The only difference is the number of products and the size of our company, which is much smaller. In this next step, we will grow our current $500,000 company to the desired $10 million company. We must fill out our profit and loss statement gaps for years 2 through 9. This table shows the projected yearly sales based on fixed growth rates for each product category. Using Excel's GoalSeek function, I can calculate the specific growth rate for each product category to get from where the company is today to achieve the quantities for the $10 million company in year 10. I estimate sales and marketing to grow proportionally with growth in sales. From the number of products, we will calculate the direct staff. The black numbers are the calculated numbers of staff required to deliver the number of products. The blue numbers in this table are the actual number of staff. The indirect staff is estimated based on the size of the direct cost staff. The same gap filling is done with the expense budget for each year. In our example, I have upsized our facility twice, resulting in higher lease and utility costs. I have added legal fees in year 5 to protect our growing company from lawsuits. I have kept business coaching constant until year 5, when I increased the number of coaching sessions from 2 times per month to 4 times per month. This expense budget gap filling exercise allows you to envision how your budget must change as your company grows. Now that you've filled in the gaps, you can see how profitable your company is in each year of your growth. You may notice that your profit is a loss in years 4 and 5. Throughout this growth plan, your profit drops as a percentage of revenue and it never returns to your current profit rate. This is what scares many small business owners away from taking on growth. Profit is one thing, but cash is king. Our company needs a van for each worker A. In year 1, we leased a van. However, we want to reinvest profits to purchase vans in subsequent years. This will require cash to be spent on these new assets. We will also need to pay taxes on the company's income each year. After we subtract the cash for the vans and taxes, we can now see the cash flow picture clearly. From a cash flow perspective, we show a negative cumulative cash picture for years 2 through 9. And for you accountants out there, I realize that I'm not accurately showing asset and depreciation costs. This is a model, so please put your OCD off to the side for now. You must consider one more item with cash management: the timing of your company's various costs. I call this a cash shift. It's a negative cash shift if you must pay employees before getting cash from customers. Likewise, if your customers pay in advance of you paying your employees, it's a positive cash shift. Let's assume in our model that we must pay for sales and marketing a year in advance to gain product sales in the following year. This will create a negative cash shift for sales and marketing costs and make our already ugly cash flow picture look even worse. Don't worry, we will fix all of this in our next step. This final step will allow you to tweak this model so that you know how to scale. Here are some ideas I would consider for our current model. First, I would improve worker productivity. Instead of 80%, maybe workers could be 90% productive. Or maybe I could just include the inefficiencies of our workers in our direct costs. I could increase prices to improve margins. I could decrease compensation to our staff. I could decrease sales cycle time to reduce cash suck associated with the negative cash shift of sales and marketing. I could lease vans instead of purchasing to reduce our cash flow problems. I could seek investment capital to fund our cash flow shortfalls. What about considering slower growth to reduce cash flow problems? So once you have tweaked the model, you now have a plan to scale your business in a way that won't cause growth anxiety. If indeed you need investment capital, you will be able to speak confidently with investors about how they will get a return for their investment. I want to thank you for watching, and I hope you've learned more about how to scale up your business. If you'd like me to do this exercise with you, I'd be glad to help you create a scaling plan for your business. I've left a link to schedule a no-cost discovery call in the description below. If you want to get notified when I publish more helpful business videos, please subscribe to my channel. And until we meet again, I wish you the best in your business and in your life.